Have you ever thought about what happens when you earn money in one country but live in another? It sounds simple, but it's actually a giant global puzzle. Today, we're going to untangle this incredible tax maze that affects everyone, from a freelancer working remotely to the world's biggest companies. We're going to break down the rules of the game.
So here's what we're covering. First up, we'll get right to the heart of the problem all these tax systems are trying to fix. Then we'll look at the two main ways countries do it, taxing by territory versus residence. We'll also dive into a really rare and pretty controversial approach. After that, we're shifting gears to the high-stakes world of corporate taxes. And finally, we'll see how the world is trying to catch up and create a fairer system for today.
All right, so let's start at the very beginning. What is the fundamental challenge we're even talking about here?
Okay, imagine this for a second. You live in Spain, you work remotely for a company based in the US, and to make things interesting, your salary is paid into a bank account in Japan. So who gets to tax that income? Is it Spain, the US, Japan, or could it be all three? This is the exact puzzle international tax law was created to solve.
You know, without any clear rules, you run into two massive problems. The first is double taxation, where you get taxed by multiple countries on the very same dollar you earned. Obviously, nobody wants that. And the flip side is no taxation at all, where your income just kind of slips through the cracks. And let's just say governments are not big fans of that outcome.
And really, that's what international taxation is all about. It's the official set of rules that helps figure out who taxes what when a person or a business is dealing with different countries. It's all about bringing some order to a world where money can cross borders in a split second.
So how do countries actually solve this? Well, it turns out the world has mostly settled on two main approaches, what are called territorial and residence-based systems.
First up, let's talk about the territorial system. This one is pretty straightforward. A country that uses this system only cares about income that's earned from a source inside its own borders. You make money there, you pay tax there. If you earn it somewhere else, not their problem. Now, the other big approach is the residence-based system. And this one kind of flips that logic on its head. In this system, a country taxes the worldwide income of its residents. It doesn't matter if you earned that money down the street or on the other side of the planet. If you're officially a resident, they say they have the right to tax all of it.
So it really just boils down to one simple difference. A territorial system is all about where you earn the money. A residence-based system is all about where you live. Two totally different philosophies for solving the same exact problem. And this isn't some obscure thing. Countries all over the world fall into one of these two camps. You've got places like Hong Kong, Singapore, and Panama using a territorial system. But then you have major economies like Canada, Australia, Germany, and Japan that have all gone with a residence-based model. It just goes to show you there's no single right way to do it.
So what happens when these different systems overlap and things get messy? Well, to stop it from being total chaos, countries sign things called tax treaties. The best way to think of them is like a rule book for two nations playing a game together, making sure everyone knows who's supposed to do what so that people don't get taxed twice.
Okay, but then there's a third way. And this is where things get really, really unusual.
Well, almost every country on Earth picks one of those first two systems. A tiny handful of them do something completely different. They don't really care where you live, and they don't care where you earned your money. They tax you based on just one thing, the passport you hold.
And when I say a tiny handful, I mean it. For all practical purposes, there are only two countries in the world that tax their citizens on worldwide income, even if those citizens never live there again: the United States and Eritrea. So what does that actually mean? Well, it means that a U.S. citizen living in, let's say, Portugal, still has to file a tax return with the IRS in America every single year. They have to report all the money they made from all over the world, even if they haven't stepped foot in the U.S. in decades. And this has some serious, real-world consequences. The reporting requirements for Americans living abroad can be mind-bogglingly complex. It's gotten so tough, in fact, that it's led to a huge spike in people giving up their U.S. citizenship altogether. Back in 2020, a record number of people, over 6,000, did just that, partly because of the sheer headache of this very unique tax system. So that covers individuals, but the game gets way more complicated, and the stakes get a whole lot higher when we start talking about multinational corporations. I mean, think about it. With globalization and a digital economy, where does a company even make its money? It's all become so blurry. And this has created some massive, complex loopholes that big corporations have gotten incredibly good at using to pay as little tax as possible. The official name for this is base erosion and profit shifting, or BEPS for short. I know it sounds super technical, but the idea is actually pretty simple. It's about using legal tricks and gaps in different countries' tax rules to make profits disappear from a high-tax country and then magically reappear in a country with super low or even zero taxes.
So how does this magic trick actually work? Well, the real-world strategies are unbelievably complicated, but here's the basic recipe. Step 1. A company in, say, Germany, pays massive royalty fees to a subsidiary it owns in a low-tax country like Ireland. Step 2. That Irish company then passes the money to another subsidiary, this time in a zero-tax place like Bermuda, a tax haven. And voila! Step 3. The profits have now been legally moved and can just pile up in that tax haven, almost completely untaxed.
And of course, none of this works without that key ingredient, the tax haven. A tax haven is basically a country that makes itself super attractive to foreign companies by offering incredibly low or even zero taxes. And often, this comes with a lot of financial secrecy, which makes it the perfect place to park all those shifted profits. As you can probably guess, all of this has led to a major global backlash, and now a worldwide hunt for a much fairer system. But the game is finally starting to change. Countries are teaming up to fight back. Led by organizations like the OECD, there's this huge global push to completely rewrite the tax rules for the 21st century. One of the biggest ideas on the table is a global minimum corporate tax, which is designed to stop this race to the bottom and make it a lot harder for companies to hide their money.
Which really leaves us with this one final, massive question. As our money becomes more and more digital and it flows invisibly across borders in the blink of an eye, can any tax system, a system that was designed for a totally different era, ever truly keep up? Answering that is going to define the future of this whole global tax maze.